Hello, accounting superstars. Welcome to the Accounting Superstar Station. I'm so glad you're here. I'm Professor Don Bush, and I've been teaching accounting for about 30 years and been a CPA for about that long. And I've got a lot of great ways to explain accounting. So I hope that you'll stick around and learn a little bit about pensions. So this is the first example of 5. And what I did in this example is I made things as easy as possible just so you could get a start on this. So here's what we have going on. We've got when we get to a construction, the construction company that you don't want to have work on your home, and they've got a pension. And what I have here for you is I've got a pension worksheet. And this pension worksheet, it's not an official part of our accounting records, but it's to help us figure out what is going on with this pension. And I think this pension worksheet is brilliant. It is really cool how it all works together. It all ties together. So let me explain what's happening. Over here on the far left-hand side, we've got items, and we've got things like the beginning balance and employee service cost and employer contributions, and we're going to do a journal entry, of course, and end of year balances. So are the things that are happening, and with each example there'll be more and more things. So you want to watch this video and get a good start, and then watch the other videos, and it'll help you understand pensions. Although I gotta say, it's not the whole story. There's a lot more to this than what I'm going to share, but at least this will give you a good head start. In the middle, we've got the journal entries. So we're going to use this middle section to help us figure out a journal entry. And you can see I've got the journal entry right down here below. And over here in the green, I've got it listed as memo record, but what it is, it's a representation of the accounting records for the third party that takes care of the pension assets. It might be an investment company, an insurance company, maybe a bank, who knows, but it's a third party. It's not a part of when we get to a construction, but their job is to take good care of these pension assets and ensure that there is enough money for our retired workers. So this is how it all works, folks. Let's start with the first line here, the balance, January 1st, 2001. So I've got some numbers right here in this area. They're in dark blue with white numbers. And here's what's going on. Think of it this way. I think it's the easiest way to think of it, is think of it as here we have a representation of the books of the third-party trust fund here. And we've got $10,000 debit. So what that means is that the pension assets add up to $10,000 at this moment in time. And right next door, we've got projected pension liability. Now, folks, what's going on with this projected pension liability is that it's got that word projected there on purpose. And projected means projected out into the future. However, whenever we have numbers and money projected out into the future, we always find the present value. So this $8,000 represents the present value of the projected pension liability. So as time goes on and out into the future, our workers are going to be retiring, and we're going to owe them some money for their retirement, but that projected pension liability is discounted down to the present value. So that $8,000 represents the present value. Now we've got $10,000 of assets, $8,000 of liability, which means this fund at the beginning is overfunded, which is a nice place to be. Not very many pension funds can say that, but they are overfunded at the moment. Now this number just to the left, pension asset liability, since it's in the blue area, this is part of the when we get to a construction company. So this everything that's in this blue area is going to help us record a journal entry, which is right down here. So we've got $2,000 debit. And you might say, oh, hey, I think there's a mistake. Shouldn't that be $2,000 credit? And the answer is no, that should be $2,000 debit. So what is going on? Well, this $2,000 is not meant to make these two numbers balance out. So that's how you got to think of it. So, but what this $2,000 represents, it's if we were to net the $10,000 debit with the $8,000 credit, if we were to net those two numbers together, we would get $2,000 debit. To say it all another way is the pension fund is overfunded by $2,000, and so it's going to be represented as a debit because assets are debits. So moving on, we've got employee service costs. This employee service cost represents our current workers who are currently working and earning that pension. So this year they earned $3,000 worth of pension expense. So we're debiting pension expense for $3,000. And if we have a debit, we need a credit, which increases our liability. Now, this is in the representation of the third-party trust pension trust fund. So, but you'll see how it all works out. It's really pretty cool how it works out. So, $3,000 debit, $3,000 credit, and whenever you do these entries here, make sure the horizontal lines balance. $3,000 debit equals $3,000 credit. When we get to a construction sent into the pension plan, $2,000 to help fund that plan. So we have $2,000 credit and $2,000 debit over here. And so horizontally, we balance out. Horizontally, we balance out. You got to watch that. Now, those were the only two transactions that happened during the year for when we get to a construction. In future examples, there'll be many more transactions that happen, but for now, we're just trying to get the basic idea. So at this point here, we need to formulate the journal entry. So what we're going to do is we're going to add up the pension expense column, which I hope is easy. $3,000 debit. We're going to add up the cash column, which is $2,000 credit. So we've got a $3,000 debit, a $2,000 credit. In order to make this all balance, we need to have a $1,000 credit in this column here, because a $1,000 credit and a $2,000 credit equals a $3,000 credit. So that's how we get this to balance. Coming down to the very last line. The very last line is very much like the very first line. In fact, this last line is going to become the first line next year. But how does this work out? Well, here's how it works. The $2,000 debit, and we've got a $1,000 credit, which nets to $1,000 debit. So coming to the next line, the projected pension liability started out at $8,000 credit. We're adding a $3,000 credit, which adds up to $11,000 credit. Pension assets, $10,000 debit. Add to that a $2,000 debit, we got $12,000. Now to make sure this all works, here's what you got to do. Is this, again, for about the fourth time, this is a representation of the pension fund, not when we get to construction. They've got $12,000 of pension assets that are probably investments and stocks and bonds. And they've got a projected liability of $11,000 credit. So if we net these two numbers together, the $12,000 debit, the $11,000 credit, we get $1,000 debit, which equals that right here. So it works horizontally and it works vertically. So when you're doing this worksheet, if it doesn't work out this way, there's a mistake someplace. We're almost done. Coming down to a journal entry. Here we are. So here's the journal entry for the pension for 2001. Where do we get the numbers? We get the numbers right here, right across here, and it says journal entry for 2001. So here we go. Pension expense, $3,000. We get it right from there. Cash credited for 2000. We get it there. Pension asset liability, we get it here, and there we are, $1,000 credit, all matches. Now on the balance sheet, it's going to show up as a non-current asset. Not a current asset, non-current asset. So here we are, we're coming down to right here. So the non-current asset, pension asset liability, which represents this column here, is a $1,000 debit, which means it's an asset. Assets are debits, liabilities are credits. So pension asset for $1,000. There we go. So folks, that is your very first introduction into how pensions work. By the way, these are defined benefit pensions, not defined contribution type of things. Defined contribution retirement plans are things like 401ks. So these are kind of old-fashioned. And the reason why I'm teaching this is because there are a lot of pension plans that are in deep, deep trouble. And it's going to be interesting to see how the future holds for pensions, especially for state and local pensions for teachers and policemen and firemen and government workers. Those are, in some states, they're severely underfunded. So, ladies and gentlemen, I hope you got something out of this very first example for pensions. And I hope you'll watch the next few examples because they go into a little bit more detail. And if this helps you out, let me know. Hit that like button, hit the subscribe button, and that will encourage me to make more videos for you guys. That way I know that you like this stuff and it's helpful. So until next time, I'll see you later, and over and out.